Good afternoon all. Welcome to ESR-REIT's 4th quarter and full year 2020 results video. I hope you are all keeping healthy and safe. I would like to start by sharing a snapshot of the REIT's financials and portfolio performance. Core DPU for 4Q 2020 increased by 5.9% quarter-on-quarter to 0.741 cents, bringing the core DPU for the financial year 2020 to 2.8 cents. The FY2020 core DPU is down year-on-year due to the impact of COVID-19. However, ESR-REIT's operational and cash flow metrics have shown signs of stabilization. As such, the remaining 3.5 million or 0.099 cents per unit of distributable income previously retained in the first quarter of 2020 for cash flow purposes will be paid out as part of the 4Q 2020 distribution. Gross revenue increased 4.2% quarter-on-quarter to 59.3 million in the 4th quarter of 2020, while net property income increased 7.9% quarter-on-quarter to $43.6 million. However, the financial year 2020 gross revenue and NPI declined year-on-year, mainly due to the rental rebates given to tenants as part of ESR-REIT's measures to support tenants adversely affected by the COVID-19 outbreak, as well as under the Rental Relief Framework pursuant to the COVID-19 Temporary Measures Act. In addition, the conversion of some assets from single to multi-tenancy, where certain property expenses previously borne by the master tenants are now borne by the REIT, as well as non-renewals and downsizing by certain tenants also impacted our earnings. Nonetheless, rental collection levels in FY2020 have been over 97% since the onset of COVID-19. We have previously estimated that about $10.1 million of rental rebates may be required for tenant support. We expect approximately $8 million to be utilized for rental rebates and lease restructuring, which has been provided for. We do not expect to provide much rental relief going forward, barring unforeseen circumstances such as the introduction of further mandatory relief measures by the Singapore government. Operational metrics have remained stable. The portfolio occupancy rate has remained resilient at 91%, consistently above the JTC industrial average, and we achieved a tenant retention rate of 84.6% in 2020. Major tenants we have retained this year include C&W Services and GKE Warehousing and Logistics. Rental reversions in FY2020 have remained relatively flat at negative 0.6%. During the year, we renewed leases for 2.23 million square feet of space and secured new ones for 1.6 million square feet for a total of 3.9 million square feet. We have seen an uptick in demand and prospects coming from pharmaceutical, advanced manufacturing, precision engineering, third-party logistics providers, and e-commerce companies. As at 31st of December 2020, we have renewed over 19% of leases due for renewal in FY2020, ensuring that the leasing momentum continues into 2021. On to a quick update on our ongoing asset enhancement initiatives or AEIs. AEI works have commenced at 19 Tai Seng Avenue to upgrade the building specifications to cater for a greater variety of high-tech tenants. The AEI is on track for completion in the 3rd quarter of 2021 and is expected to generate an estimated yield on cost of 7 to 9% on a stabilised basis. The asset enhancement initiative at UE BizHub EAST is now in its final stages and is expected to be completed in the 1st quarter of 2021, offering a city lifestyle experience for the working crowd. The newly completed food alley there is already open to the public and boasts an improved design that creates a more conducive dining environment for tenants and visitors. The rest of the rejuvenation works are on track to be completed in the 1st quarter of 2021. In terms of managing the REIT's capital structure, we continued our disciplined and proactive strategy with 89% of borrowings on fixed interest rates over the next 2 years. As at 31st December 2020, ESR-REIT has a gearing of 41.6% and a weighted average debt expiry of 2.2 years. The weighted average all-in cost of debt has been reduced from 3.92% as at 31st of December 2019 to 3.54% as at 31st December 2020, and the portfolio remains 100% unsecured. We are in advanced discussions with our lending partners to refinance all debt due in 2021 ahead of their expiries. The new loan is expected to lengthen the REIT's weighted average debt expiry and reduce the overall cost of debt. Now, I would like to share more about our strategy for the financial year 2021. First, our key focus in 2021 is enhancing the operational and income stability of the existing portfolio and positioning it to capitalize on the economic recovery. Second, we will reduce uncertainties in the REIT's capital structure via early refinancing of all debt expiring in financial year 2021. Third, we will continue to focus on organic growth initiatives by rejuvenating assets to position them to stay relevant to industrialist space needs. Upcoming AEIs in 2021 include about 60 to 70 million of identified enhancement works and the development of a multi-tenanted high specifications building at 7000 Ang Mo Kio Avenue 5. We also intend to divest up to 50 million of non-core assets in line with our portfolio reconstitution strategy to improve our portfolio quality. Lastly, acquisitions remain an integral part of our growth strategy to build a portfolio of resilient, future-ready assets. We will continue to acquire scalable, value-adding single asset and/or portfolios locally and overseas, in markets where the sponsor, ESR Group, has an established operation platform. We will also be looking at development assets located in countries where the sponsor has a footprint. Broadly, we expect industrial market rents and prices to remain soft in the coming quarters as the recovery of global demand and growth is very much dependent on the evolving COVID-19 situation and the vaccination progress. Despite the challenging market conditions, we will look to optimize the portfolio by rejuvenating assets and positioning them to stay relevant. Given the REIT's relatively stable financials and operating matrix, we look to use the transitional downtime during this COVID-19 period to capitalize on more organic growth opportunities within the portfolio to be ready for the post-COVID-19 world. With that, I end my report and I thank you very much for watching.